Welcome to Simmonds Stewart's second webinar on a bunch of stuff to do with technology companies, capital raising, and startups. So we've got about 30 people online so far, and people are still jumping on. So I think what I'll do is I'll just get the introductions out the way before we dive into the detail of it. So the Simmonds Stewart team today presenting are me, Andrew Simmonds. I'm a partner in our Wellington office, and I have been in charge of Simmonds Stewart's efforts on the free template documents and document makers, and particularly around creating useful content like our template term sheet and template document maker. And I've also been involved in giving feedback to NZVIF and to the Angel Association on industry standard investment term sheets. And my co-presenter today is Julie Fowler, who's a partner in our Auckland office, and Julie can wave to say hello there. You can work out which one's Julie.
Hello.
Julie, like me, spends a lot of time doing capital raising and helping tech companies raise finance and helping investors invest. And the starting point for Julie is a term sheet more often than not as well. And we've also got Lee Bagshaw with us. He's the third of our partners that in our tech capital raising team, and Lee is involved in capital raising activity in New Zealand, but also in Southeast Asia. So he's got an interesting perspective on the role and sort of contents of term sheets, both in New Zealand and in the great wide world. But Lee's just here today to help us curate questions. What we found with the last webinar was it was a bit hard for the presenters to keep track of the questions as we went along. So Lee's going to curate those, and he might jump in with the odd question as we go. We'll see. So if you do have questions, jump them in the chat, drop them in the chat, and Lee will make a note of them, and we'll try to keep 10 minutes at the end for questions. And if there's lots of questions, we can run over a bit past 1 p.m. So why have a term sheet, or what is the purpose of a term sheet? So when a tech company is going to be raising capital from investors, you don't just jump straight into a bunch of final documentation. It's not like going to the bank for a loan and they send out the mortgage and loan agreements and guarantees out to your lawyer, and all you do is just go and sign them. It's a lot more bespoke process than that. And the first step usually is finding some people that want to invest in your tech company and providing them with some information about what you do to get them interested. But quite early on in the process, there needs to be some document that's exchanged between the investors and the company, setting out the terms of the investment deal. And in the tech company, startup, high growth company space, this is often referred to as a term sheet. In other sort of areas of business, sometimes a term sheet might be called a letter of intent, or it might be called a memorandum of understanding, or that sort of thing. But essentially, in the capital raising world, it tends to be called a term sheet, and its purpose is to set out the summary terms of an investment deal, and it's not intended to be binding. So like a letter of intent or memorandum of understanding, it's there to help the parties negotiate the key stuff up front, so that they can get to the point where they think they actually have a deal in principle. Now, if you are raising money from VCs or sophisticated investors, they will no doubt have a term sheet that they will give you as the company, and you'll be reviewing their term sheet. And that's often the practice internationally. In New Zealand, it's a bit more horses for courses. So often New Zealand companies are trying to raise money from a bunch of different sources, and often from private investors, angels, angel groups, high net worths, even corporates. And when that's going on, it's quite often the case that the company has to prepare the term sheet themselves and to actually provide that to investors along with other information about the company. And that's essentially sets out the investment ask that the company is seeking, and not just the money, but also the terms. Now, although term sheets are not meant to be legally binding, and generally aren't, this is probably the most important time to go and talk to a lawyer that understands capital raising for tech companies, because what you agree in your term sheet is the key stuff, and it's actually quite hard to change it down the track. Investors tend to get quite grumpy when they have term sheets that companies or founders want to backtrack on. It is sometimes possible to do that and to plead ignorance, or just use brute force to try and renegotiate things. But it's far better actually to try and get it right at the start. And I think, as we see when we jump into the detail of a New Zealand term sheet, actually they're quite a summary document, and they seem simple, but there's a lot of complexity hiding behind them. So your typical 3 to 4 page investment term sheet would operationalize into 40, 50, even 60 pages of legal documents, and your investors have a pretty clear idea in their mind what that is like, because they've done it before. But if you're signing up to a term sheet for the first time, 3 or 4 pages, you may not fully appreciate what the sort of detail of what that's going to turn into. So essentially, it probably sounds a bit self-serving, but it's definitely one of those cases where we think you get the most value out of talking to your lawyer at this stage, rather than talking to them only when you've got them to sign the document, or when you've got the full documentation from your investors. Another thing that we don't have time to dive deep into today, but it's an important part of this phase, is your capitalization table. So part of your term sheet will be setting out what shares you've currently got on issue, how many shares you're offering to the investors for the amount of money you're seeking to raise, and also incorporating the details of any employee share schemes that you have in place or that you plan to put in place, and details of any convertible notes or that sort of thing that you've got on issue. And we've got a template for this on our website, and it's perhaps something we'll dive into a bit more deeply in another webinar, but it'll come up a bit in the course of today's discussion. So what we thought we would do now is, rather than talk about it in the abstract, that we would dive into an actual example of a term sheet, and we do that by using our nifty Simmonds Stewart document maker. And I'm going to share that screen. Everyone should be a bit afraid with 3 lawyers trying to drive technology here. Oh, there you go. No? Oh, there we go. Share screen. There we go. Okay, so what we should have here on screen is the Simmonds Stewart website. You can see that okay, Julie?
Yep, I can see that.
Yeah, so a lot of you will be familiar with this. So under our resources tab, we've got a bunch of free resources that tech companies and investors, and for that matter, lawyers, can use. And we've been putting a lot of effort into these automated document makers to try and give people tools to create pretty good legal documents that through filling out basically web forms. And I'm navigating here, as you can see, to making a term sheet. Now, I'm already, as hopefully you can see in the top right of the screen, the font choice or color isn't great, but I'm already logged in to this part of the Simmonds Stewart website. If you haven't done this before, you'll have to register. You can do that using a LinkedIn account or entering an email. The reason why we do that is because it allows you to go back to documents that you've made or partly made and reuse them or finish them or change them. Without that login, we wouldn't be able to do that. So this is what all our documents look like. They remember who you are, and give you the little intro video, which is narrated by our CEO and explains how to use the document makers. In this, you generally have to scroll down to the bottom to see if there's anything you've got to fill in at the bottom before you go down to next. And in this case, we're going to select that I want to design my own term sheet, but there is a sort of a cut down Simmonds Stewart suggests one, which is super founder friendly. We've actually invited a couple of VCs or investors to create their own versions. So we might have the Lance Wiggs selection or the Movac selection, but so far they haven't taken us up on that. So there's some preliminary stuff you have to have about who is the company that is raising investment, and this time I'm saying it's Simmonds. How many founders does this involve? And actually I've jumped ahead. So the company name is Simmonds. Will any of the founders be subject to lock-up or vesting arrangements, or will the founders be giving warranty? So these are all things we'll talk about in the context of the term sheet, but I'm going to say yes, because in this case, our founders are going to be subject to some vesting, which I'll explain, or Julie will explain on one of the later pages. So just to keep it easy, we're just going to say this is one founder, and we're going to add their name, and we're going to say Lee Bagshaw is the founder. And we'll just have Lee. He can be the one that's subject to the lockup and give the founder warranties. Seems fair. And then we just jump to the next page. So we can add all our investor details here. Now, sometimes you won't know these if you're in the early stages of your process and you're about to go looking for investors, and they're the kind of investors that want to see a term sheet from you. Then you might just leave this blank, and that doesn't matter. But if you do know the names of the people that are investing when you do this, then you can enter them in. If you do want to leave them blank, obviously, you can put some square brackets in here. But in this case, Big Law Limited might be investing in Simmonds, and they are investing $1 million. And I think that's the right amount of zeros. And we've got a question about whether NZBIF, the New Zealand Venture Investment Fund, is one of the investors. That's relevant because NZBIF has a bunch of specific things that they require in investment deals. How long this is going to be relevant, I'm not sure, because there's a review going on of NZBIF's role in the NZ tech investment marketplace, and they're not being as proactive in co-investing along with the angel groups at the moment. They're being more selective anyway, but all of that could change and their terms might change. So whether or not this is relevant to you will depend on how all of that plays out. But we're going to say that Big Law's all of the investors. But if you only know the name of one and there's more to come, then it gives you the option of filling those details in later. So it's the kind of preliminary stuff, and this is where where things get into more the interesting detail. So, Julie, I'll hand over to you. I mean, I'll continue to hold the clicker or the mouse, as it were, and fill in the details. But if you want to talk to the terms and take it from here.
Yeah, okay. So while we're talking about these terms in the context of our doc maker, these are the type of terms that will come up in any term sheet, whether the company presents and prepares the draft term sheet or whether it's presented to you by your investor. So the first thing that comes up in our document maker anyway is a description of the business. So you just want to fill in a brief description here. Clearly that aids clarity so that everybody knows at a high level what the nature of the business is. And it is helpful for the purposes of preparing the long-form documents, particularly, for example, in relation to any non-competes that may be included, which may bite against all of the shareholders or perhaps just the founders and existing shareholders. Moving on down to the type of shares which are being issued. Now, typically the type of shares to be issued are ordinaries or prefs, and the preference shares simply mean that the shares carry a liquidation preference. That means that they have the same rights as the ordinary shares, but it means that the investor can get their money out first if there's an exit event, or if things go terribly wrong, the company goes bust and it has to be liquidated. In those circumstances, the investor gets their money out first. Generally, angel groups might ask for that liquidation preference. Other types of investors might not. It's a fairly vanilla term, and it's not something that I would resist too strongly, because it is reasonably standard from some types of investors, and it's not too big a ask for them to get their money out in those circumstances, to get their money out first. Then you need to think about how much you are looking for. Clearly that's really important, and you'll have thought about that a lot in the process of preparing for your capital raise. Our term sheet provides for two options. Either there's a fixed amount, say $1 million, or you might say, actually, I could achieve quite a lot of my business plan for $500,000, but while I'm going through this horrible process of capital raising, if I can get interest above that, I'll take more than that. So in which case you would set a minimum amount of, say, 500,000 and a maximum of 1 million. It is, I think, important. Sorry, yes?
Sorry, Julie. I was just zooming in because somebody asked a question to say if I could zoom in the website a bit because it was a bit fuzzy.
Oh, yeah.
I've done. So we were going for preference shares in our term sheet, were we?
Yeah, go for preference, yes. And I think we can just go for a fixed amount of investment amount. So you're going for the million. Okay.
Always gets me. How many zeros? There we go.
Yeah, the zeros, quite important. Got that?
Yes.
Okay, so the next thing that is really important to be clear about in your term sheet is your pre-money valuation. And that's obviously something that is a matter for discussion between you and your investor. But from the company's perspective and the founder's perspective, it's really important that they do have a full understanding of the implications of setting that pre-money valuation and agreeing it, because the price per share is calculated on the basis of the pre-money valuation divided by the shares on issue. But when you're thinking about the shares on issue for these purposes, it's calculated on a fully diluted basis. That means if you have an option scheme, you need to calculate those options as if they've been fully exercised. So that means if you've got this, that applies whether or not your options are vested or unvested, or in fact whether you just have an option pool and you may not have even granted options under that. If you have that pool concept, you need to assume that they're all that they've all been granted and that they've all been exercised. The other thing that typically you need to take into account here is if you've been granted or entered into any convertible notes. Again, you need to include those for the purposes of your fully diluted capital as if they've been converted to shares. Now, these are really important calculations because those conversions and exercises take place before the investor invests. So they dilute the existing shareholders and founders, but obviously not the investor, and it affects the price per share. So you do need to have a really good understanding of that when you're thinking about what your pre-money valuation is. And that again is where being on top of your capitalization table is really important, because you can see clearly what the effect of the fully diluted basis is essentially on the dilution of the existing shareholders. Okay.
So just a question from, I think, Leanna. I can't see the names on my screen at the moment, but just about preference shares, and does that mean that a preference share has less say in the running of the business and ordinary shares control the business? Unfortunately, it's sort of the opposite way around. So the preference shares generally have all the same rights as ordinary shares, and they have some extra rights, which is the preference. Usually those preference rights in New Zealand are just economic rights, like a liquidation preference for getting your money back out first. There used to be something in New Zealand called redeemable preference shares, which were used quite a bit because they had an advantageous tax treatment, and those tended to have the features of debt, so no control rights. But that was kind of just a an aberration of New Zealand's tax law at the time. They're not used virtually at all now, and preference shares in this context are truly preferential, and the ordinary shares are just plain old ordinary. Sorry, Julie.
Yeah, it's all good. Okay, so the next box in our doc maker is the anticipated completion date. It is really important to try and agree a date with your investor as to when the investment will complete, because clearly from the company's perspective, you want the money in as quickly as possible because you need the money, and also to ease the pressure and the effect on their business of being having to go through this investment process. But often this will slip, so it's not cast in concrete.
Generally, the tradition is to set an insanely unrealistic completion date in our and hope for the best.
Yeah, and there's always, a difference between the investor's timeline and the company's timeline. Investors usually take a lot longer than companies anticipate or want, and it just seems to be the nature of the process. Okay, so payment of the investment amount. So you need to consider, and this will be something that your investor will be pushing for, obviously more than the company, whether the investment amount is paid in full on completion or whether it's tranched. From the company's perspective, obviously the best position is for that money to be paid in full on completion. That allows the company to go ahead and complete its business plan as it expects to do. And to not be waiting for the money to be drip fed in to enable it to do that. Particularly if the money is to be paid in tranches based against performance milestones, that can be a problem, mainly because the businesses can pivot, and a milestone that may have been set at the time of the investment and seem to be really relevant may not be relevant 6 months later, and yet your ongoing financing is subject to achieving that milestone, which may no longer be relevant. I have to say, in practice, I think investors have moved away a lot from tranching. Generally, we see that most investors pay in full on completion, in my experience.
Yeah, we have had a few experiences where in deals done with tranches, when a tranche has come around, some investors have not had the money to pay because they've got into financial difficulty or overextended themselves or have just changed their mind and say they haven't got the money to pay. And so you're actually taking a credit risk on your investors, actually, and that sometimes has quite disastrous, certainly in one case, had quite disastrous results for a company. So if you can, as Julie says, it's actually a lot less common that investors ask for this in New Zealand, but from your point of view as a company, if you can avoid it, definitely do so.
Yeah, and the problem there is, even if it's entranched and to be paid on defined dates, if your investor doesn't pay, the company has an enforcement issue because they probably can't afford to take legal action against the investor to get the money out of them. So you really are at the mercy of your investor moving forward in practice. Okay.
Something we've done in the doc maker is, we've generally pre-selected the most common outcome, and certainly the outcome that we would recommend. So you'll see that in full on completion was pre-populated. So often the default option will guide you to what's the most likely or the most common thing in the marketplace.
Yeah. Okay, so moving on to employee share option schemes. It makes sense, and it's quite common for a company to establish an ESOP or to extend its ESOP allocation at the time of an investment. And there are a few reasons for this. One is that it allows the allocation of shares, the grant of options, issue of shares to employees to be authorised and approved in the shareholder agreement, which is part of the long form documentation. And so the company doesn't have to keep going back to shareholders for approvals to put in place its ESOP arrangements. The other key reason for thinking about it at the time of investment is its dilutionary effect and who it dilutes. So you need to agree that, often you need to agree that up front with your investor, and you need to agree the size of the investment pool. It's fairly common in New Zealand to have a 10%, to provide for a 10% option pool. That can be bigger or smaller, but I would say that 10% is fairly common. And you need to build the option pool into your capitalization table. So I won't get too much into share option schemes because I know we covered that in our last webinar, but the key thing about option schemes is that they are not shares. So when you create your option pool, that option pool will not be seen on your share register or your company's office records. And the only place that it's really recorded is on your capitalization table. And it's important there because, as I mentioned, of its dilutionary effect on the other shareholders. Obviously, it's also provided for in the shareholder agreements and the approval processes. But it's important to understand that it really only appears in your cap table. And it's a sort of it's a description of what will happen in the future rather than a current right that employees have.
Julie, there was a question I think we should now covered from Joe Simmonds about whether you include unallocated or ungranted options when you put together the cap table.
Yeah.
In connection with the ESOP, and I think you've just answered that. But yeah.
Yes, definitely. So whether or not you've granted them, whether they're not they're vested or unvested, if you've allocated an option pool, so in your minds you're expecting to grant options up to the pool percentage, then you should include it in your capitalization table. Yeah.
So basically what that means, it's a fully diluted capitalization table, and it leads to a fully diluted pre-money valuation or pre-investment valuation. So basically it encourages you to ask for a higher pre-money valuation because you have to take account of the dilutionary effect of your ESOP. But I think we'll do a cap table. We'll get our cap table guru, Chris Wilson, to do a cap table show and tell, but also demonstrate some of the more complicated maths that goes on when you've got multiple things converting, just to explain that in a bit more detail. But it's a basic cap table is easy to make with the template on our template section of our website. Somebody else had a question, I think, Emily, about whether there's a link to our ESOP webinar. Emily, if you just jump on our resources tab, you'll see there's a webinar tab, and you can go to any of the past webinars or register for more webinars on there. Sorry, Julie.
That's all good. Founder shares. Did you want me to talk about founder lockup?
Oh, sorry, I can't pass that. There we go, yes.
Yeah. Okay, so so founder lockup as a concept means that a founder shareholder is restricted from selling its shares for a period of time. Often that can be between 2, 3 or 4 years. From the founder's perspective, that's probably not something you want to sign up to. Having said that, as a founder, you generally wouldn't expect to be exiting the company other than in a situation where all of the shareholders are able to exit the company. And from the investor's perspective, if they have a founder lockup, it gives them the confidence that the people that they really are investing in to drive the business forward will be around for the whole period. So while I don't think founder lockup is great, I feel that that's something I would agree to more easily than the next one, which is founder vesting. Now, founder vesting means that despite the fact that a founder might, at the time of investment or immediately after investment, hold, say, 40% of the shares in the company, what it means is that a certain percentage of those shares are subject to buyback by the company. So if the founder leaves, say within 1 year of the investor investing, the company has the right to buy back a percentage of those shares. And it could be, say, half of those shares. So because the founder has left, the consequence of that is that he loses many of his shares and may walk away only holding 20% of the company, whereas he may have given 5 years of his life to get the company to the point it is there. So founder vesting is one that, as a founder, I would try to resist quite strongly. You can see.
I guess I've got a slightly. Can I jump in, Julie? I've got a slightly different perspective, I guess. I mean, I used to feel that way. I think it depends a lot on the stage of the company, though. So, and actually, I think our recommendation is that companies, when they start up, they actually think about putting in place founder vesting arrangements between the founders, not as something that's driven by investors. I like it less when it's driven by investors. But if you're going into an accelerator like the Flux Accelerator or the Lightning Lab Accelerator with a bunch of people you don't know that well, and you're dividing the company up, say, a third, if somebody leaves after a couple of months or 6 months or a year, and retains their 1/3 shareholding, and you have to continue to live on pot noodles whilst you try and turn this into a unicorn company, you're probably going to feel a bit aggrieved. So I think for young companies, particularly where people haven't been in business with each other for a long time, actually founder investing is a good thing. And I think where Julie's coming from is we do see investors try to impose this on companies that have been around for a lot longer. So 3, 4, 5 years, when a lot of equity has already been, sweat equity, if you like, has been earned or fully earned by the founders. And I think it's quite tough in that scenario. But I think for the purposes of Simart, I was assuming, Julia, a company that hasn't been gone very long. And, as a potential investor in Simart via Big Law, I really want to get Lee's nose to the grindstone for as long as possible.
Yeah, and actually you're absolutely right, Andrew. And often in these situations, the founders will already have those arrangements in place. And so there's nothing new there for the founder. It's the same obligation that they have in any event, with or without the investment. So you're right, I was looking at a different stage company with that comment.
Cool.
Oh, vesting period. Do you want me to talk that through? So the vesting period, again, that varies with the company. Between 2 and 4 years is standard. So you might say 3 years. And then the percentage of the shares which are subject to the vesting. So that means even if you left tomorrow, what percentage of shares could you keep? So if you say that because of the contributions that I've made to the company to date, I should in any event always have at least 50% of the shares I currently own. And so that might mean that 50% is subject to vesting. And then you need to consider how they vest. Do they vest only after you've spent, say, a year with the company and then you get a third of those vesting? Or do they vest monthly to reflect that you are staying on month by month? Or do they vest 6 monthly or on an annual basis? And all of those, we've seen all of those, and there's no magic or rule about how that's applied. I see, Andrew, that you've decided that they vest monthly and there's a cliff of 12 months, which is very standard.
It's probably the most common, but it really just depends. It tends to be that if somebody is keeping 50% of their shares because they're treating those as earned, that you wouldn't have a cliff, because anyway. So I'll leave a cliff in there just because it'll pop out in the finished document.
Yeah. Okay.
And on to the next page. This is back. I was going to talk to this, wasn't I?
I think so. Yes, you were.
I had a question on vesting. It's not come from the floor, but I thought I'd ask it just for the benefit of everyone. In New Zealand, when you raise money again, does the vesting period get reset, or does it carry on, or does it depend?
I think it's uncommon for New Zealand investors to reset it, but I think because that is a practice overseas for VCs to want founders to, I think revest is the term they use. I think some of the more sophisticated investors in New Zealand are starting to think that revesting is a good thing. And so it's not a big thing in New Zealand at the moment, but it could become more of a thing in the future.
Yeah, it's certainly something we're seeing more of. And often, in my experience, investors are happy to go with the vesting arrangements that the founders already have in place. But the fact that it's coming up more frequently is something that I have noticed. So it could change. So the next two, I'm going to talk to the next 2 pages on our form. And hopefully this won't be too dismayed at the pace we're going, because we've only got 3 pages to go. So we've tried to break out economic terms just to really focus on the things that drive the economic outcomes for founders,
beyond the key term of valuation. And separately, we're talking about control terms, how much of control of the company you're giving up to your investors. So I'll talk to these two slides. So preference share doesn't have any automatic preferences. It has the preferences that are basically written into the constitution of the company or into the terms of issue of the share. And so we present these options for potential use, but quite a few of them aren't used that often in New Zealand. So a preferential dividend, for instance, it's fairly rare in New Zealand that investors ask for a preferential dividend. I know that there are a couple that do. I think Derby Capital, who are more of a later stage venture capital investor, like preferential dividends to guarantee a certain return to them. It tends to be the case, though, that these kind of preference dividend tends to be offered more for more established tech companies, and when you're getting a very high valuation being offered. So although you may not be giving up much of the company by way of shareholding percentage, investors do have a habit of trying to outsize their returns by other means, and preferential dividend is one way to do that. But I've clicked no because probably for most people on the call, this is something that is, or on the webinar, is not going to come up for them. The next thing that does come up in all, pretty much all New Zealand investment deals, unless it's truly a friends and family round, is some sort of liquidation or liquidity preference. And the basic preference here is that investors, when the company goes bust, if the company goes bust, I should say, I shouldn't sound so pessimistic, that the investors get their money back first from any realization of the assets of the company. So if they've invested $1 million and the company sells for $1.1 million, they'll get their $1 million, and then that 100,000 is then available to be shared amongst the other shareholders. Now that type of preference is called a one times non-participating preference. That's the American terminology for it. We'd sort of resisted for a long time using that American terminology because it kind of confused people in New Zealand, the difference between a non-participating preference and a participating preference. And frankly, it confused us, so that was a good reason not to use it. Probably shouldn't admit that. But because there's been more international VC type investors getting involved with New Zealand companies, and because obviously the investment community in New Zealand is getting more sophisticated and they spend time, on YouTube or going to investment conferences or that sort of thing, these terms are starting to become more common. So we thought we'd just run into that and use them and just try and explain what they mean. So a one-time non-participating preference means investors just get their money back, or if the company is being sold not in a situation where it's gone bust, they'll have a choice between getting their money back or having their percentage share of the proceeds of sale. I probably haven't explained that very well, but they can either get the money back or have their pro rata amount of the purchase price for the company, and they'll generally choose, well, you'd expect they'd choose whichever was higher. A participating preference is a lot more common in venture capital deals, and this is again one we've seen with a few later stage venture capital investors like Derby Capital and WNT Ventures. I think I've seen this from as well, where they have what's called a participating preference. So when the company is sold, and this is addressing more of a sales situation, they get their money back, and then they also get to participate pro rata in the balance. So if they owned 25% of the company and invested $1 million, they get the $1 million back, and then 25% of whatever was left of the purchase price. And that can have a huge uplift for the returns for the investors, as you can imagine, and can be quite bad for the rest of the shareholders. But it really depends. People using this tend to offer a higher incoming valuation, so there is less dilution at the outset. Some are more aggressive and they ask for 2 times their money plus a pro rata share of the proceeds of sale and higher. And I have seen these more aggressive very occasionally in New Zealand, but they're used to compensate for high valuations and often where there's a short time frame to talk along. And I won't carry on with that sentence because I'm going to state it the wrong way around. High valuations. A really important thing that comes up when you're negotiating a term sheet is whether or not investors get first say on any future capital raising. Now, if your company's quite early and you're raising capital from a bunch of angel investors, what you may want to do, and you probably want to do in the future, is raise money from a more sophisticated investor in the future who can take the company further, and that might be a venture capital firm, a private equity firm. It might be a big high net worth or a trade investor, a big multinational corporate. And if your company is successful at that stage, you can end up in a bit of a conundrum because you want to raise capital, but because your company is successful, your existing investors will want to put all of that investment in. And that does create some tension actually for companies at times. From the company's point of view or the founder's point of view, it'd be ideal to say there's no automatic right for investors to go into subsequent investment rounds. And from an economic point of view, that's great for the company and founders. However, you can understand that investors don't like that so much because, they kind of feel unloved and that, their money was good enough at an early stage. Why shouldn't it be good enough later on? Also, the way investors get their returns, frankly, is being able to continue to back companies that are successful over successive rounds. The balance that is often struck on this overseas is investors get to maintain their pro rata shareholding whenever there's a new investment round, but they can't gobble up all of the capital being raised. So just to give a simple illustration, if founders own 75% of the company and investors own 25%, if you're raising another $10 million for your company, if you select this pro rata option here, it would mean that the investors get to invest take 25% of this round of the next 10 million. The other 75%, the founders could invest themselves, but they won't have that money, so they can go and then get that 75% from another investor. And I personally think that's the fairest way to have these preemptive rights. What New Zealand investors like, however, is the pro rata right with oversubscription rights. So in that scenario, the investors would get to invest 2.5 million, that's the pro rata amount. And if the founders didn't take up the other 7.5 million, the investors could invest that as well, effectively locking out your desire to bring in overseas investors. And that does happen. It causes tension. If it's possible, we're encouraging companies and investors to settle on this pro rata right. Obviously, if you're getting on well with your investors and you think they're offering value, then and they can help you with the growth of the company internationally and whatever the next big thing is, well, obviously, you're going to offer them more opportunities for investment. But if all you're doing is offering them the opportunity to protect their existing investment by not being diluted and to go along for the ride as the company grows, I think this sets that right. They prove themselves to be valuable, in which case they can invest all the money in the future, or if not, they can protect their investment. Anti-dilution protection is something that comes up in most formal angel investment deals and venture capital, private equity type deals. And it's something we've argued a lot with investors over in the past about the type of anti-dilution thing. And it would have been quite a long topic in previous talks, but they're pretty much capitulated now. And anti-dilutes are the norm for formal or organised investors, but they're what's called a weighted average anti-dilute, so that I'll probably explain what an anti-dilute is. This kicks in if you are issuing shares at a lower price per share or a lower valuation than you sold them to investors previously. So what investors worry about reasonably is that they buy in at $10 a share, and then you go and decide to issue more shares at $1 per share, and they get diluted to hell, and it's been bad experience for them financially and karmically, and they don't want that. And the anti-dilution clause means that if you do issue shares at a lower value in the future, their shareholding gets topped up to take effect of that. But a weighted average anti-dilute is sensitive to the amount of money raised. So if you only raise a small amount of money at a lower valuation for some tactical or strategic reason, it doesn't result in smashing up the cap table. It just gets a few extra shares issued to the investors, which is fair. Now, co-sale, tag-along and drag-along are important economic rights, but I can see that we've got about 15 minutes, so I'll speed up a little bit at this stage, purely talk about co-sale, and I think I'll just say no. Tag-along and drag-along are important. Drag-along is the most important one. This is the threshold at which a group of shareholders can compel a minority group of shareholders to sell the company. And if you're the founders, you comprise 80% of the company, say, and you get an offer for the company, or if you're the founders and investors for that matter, and you comprise 80% of the company, you don't want 20% to refuse to sell in the hope that, well, for whatever reason, and it could actually be in the hope that you'll pay them more money to say yes, they'll sell, and that sort of greenmail situation does arise. This is something that's built into our standard constitution, that it operates this way. Generally, it's pretty standard in New Zealand for drag-along to kick in at 75%. But as a founder, you want to think about where that's set. So, I mean, to give you, an example, I think Sam Morgan owned 32% of Trade Me when it was sold to Fairfax, and the drag-along was set at 75%. So Sam couldn't be dragged as the founder. So the company was sold when he was happy for it to be sold. The flip side would have been, though, that if the drag-along was set too high, it might have protected Sam, but if he wanted to sell, he wouldn't have been able to winkle out some of the minorities. So setting it too high to protect yourself as a founder can backfire on you. Jumping through to control terms. This is something that you do need to give quite a lot of focus to. We generally, I think, suggest not setting a minimum number of directors if the founders are going to be the majority post-investment. And generally, if investors are, say, taking up 25% of the company, as is the case here, $1 million on a pre-money valuation of $3 million, that would get them one director. Usually, it's sensible to have some minimum threshold that the investor has to maintain in order to continue to have a director right. So if the subsequent rounds of investment and they ended up getting diluted down to 5%, you'd want that director appointment right to go away. It becomes a problem otherwise for the incoming investors. If founders have a majority of the shares in the company, you don't actually have to state how many directors they should have on the board, but just because it makes things clearer, we like to say that in our term sheets. But we also recommend that the founders that have the majority of shares in the company, that the balance is appointed by majority shareholder vote, so that essentially the majority can control the board. The people who have appointment rights have the ability to be represented on the board but not to exercise control. We've got provision for fees to be paid to directors here, and we've said no. Some of the angel groups do want fees to be paid to their representative director because they're not being paid otherwise, so we'll just put in a basic fee there. And then this is something you really need to focus on and think about, is what sort of approval rights are you going to give to your investors. And certainly if you're getting a term sheet from investors, it has potential to have a lot of approval rights. From your perspective, you want to give up as little as possible. These are often called protective provisions, but what they actually are rights of veto that the investors have over decisions that the majority or the board wants to make for the company. And I won't dwell on approval method, but the list that we've got here, matters requiring special investor approval, are quite common, and some of them are fine and make sense. Some of them carry quite a lot of risk for companies. Ones have got a little, whatever that is, carrot thing against them. The base position is approval can't be unreasonably withheld by the investors. The critical one that we don't like founders to agree to is a requirement for approval over future share issues, because these companies are have to be funded by, usually by further capital raising. That's the whole thing about an investment-backed business plan. And if you give your investors the ability to refuse further investment, they can essentially hold you to ransom. They won't approve a capital raise that you need, therefore you're staring down the barrel of going bust. And that can be used as a lever to get you to agree to other things. Quite commonly it's used as a lever to get you to resign as CEO, or to agree to appoint somebody else as CEO, or to put them in control of the board, or that sort of thing. And I'm not saying those are, that those sorts of things are necessarily wrong, but I think, because it might be that you're not doing a good job as CEO and somebody could be doing a better job, but being forced that on you by, because there's a refusal for you to be able to raise more capital, I think is a kind of a backhanded way to go about it. And there's just some detail in here which I'll skip over, to be honest. Information rights is a big deal often overseas for the rights that investors are going to have to get information from the company, and this can get negotiated quite hard overseas. In New Zealand, actually, it tends to be all investors get information, and it's often monthly or quarterly. We suggest quarterly. This is on top of obviously the basic annual report and that sort of thing. Monthly can be pretty onerous. And I will just jump over to Julie to do the final part of this. And yes, there we go. And maybe just jump over through this quite quickly, Julie. Yep.
Yeah, so I'm conscious of time here. So there's generally a set of conditions to completion which would be included in a term sheet. They won't necessarily even make it to the long form documents, but they are a bit of a checklist to make sure these things are being attended to during the process of due diligence. So, I won't work through these, but clearly due diligence will be one of them. Agreeing the final form of the documents is another one of them. Getting the approvals that are required. Some things you need to think about, and probably you should be doing this at the beginning of your capital raising process, is making sure that all of the IP is owned by the company, that your employees are on employment agreements, that you've tidied up any outstanding loans from shareholders. Generally, investors want those capitalised before they invest. So again, another thing to think about when you're putting your cap table together. And I think that's it really. They're not really things that should hold up completing the deal, but they're things that need to be tidied up in the investment process. Yeah? Can you
cool.
move up? So then when as part of the agreements that you'll enter into with your investors, the long-form agreements, part of it will be the subscription agreement, which sets out the mechanics for the investment and includes warranties which will be given to the investor, and statements about the company that if they are not correct, the investor can bring a claim against the company. So the first question is, who will give those warranties? Is it the company, or is it the company and the founders? From the investor's perspective, they often want, I wouldn't say often, but some types of investors do want the founders to give the warranties as well. Clearly that's quite a difficult thing for founders, because if there's a claim in respect of a breach of warranty, it means that that founder is individually liable to meet that claim, and that can be problematic. So if you do have to end up agreeing to give founder warranties, the best way to limit your liability is, the best mechanic to protect yourself is to limit the overall liability. Generally that is acceptable to investors, because what they don't want is to see the founder, driven to losing his house, but they do want the founder to think really carefully about the warranties they're giving and making sure they're giving full disclosure. So you might try and limit the liability of the founder to, say, Andrew's proposed 10,000. It's possibly a bit higher, I would think, but and then thinking
Lee's not got much to his name.
And then thinking about the period that an investor can bring a claim for, that's generally between 12 and 24 months, and I'd say generally towards the 12-month end of that spectrum. I think we can flip over the next one. That's just a really, I don't think that's worth talking about at the moment. Capitalization insurance. And then moving on to the logistics, we've skipped over a few things, but you can read about them. Moving on to the logistics is who prepares the investment documents. I think we touched on that at the beginning. Generally, it will be the company if they're taking money from more than one investor, or depending on the type of investor they're taking money from, or it will be the investor. And again, that depends on the type of investor. If you've got a VC type investor, they generally have their standard investment documents that they like to use. A question that often comes up is whether the company needs to contribute to the legal fees of the investor. Again, that depends on the type of investor that you have. The friends and family type investor, high net worth types, they generally don't ask for a contribution, but angel groups and VCs generally do. And again, if you do have to agree to meet legal fees, you should also include a maximum amount of the legal fees that you'll meet. Andrew's proposed 5,000. And
it's often 10,000, isn't it? I mean, in this case, the company's preparing the documents. Overseas investors, they're VCs, they'll ask for 40, 50,000 for their lawyers, US.
Yeah, and that can be quite a problem when you've got an overseas investor. Even an Australian investor, they'll expect a much greater contribution to their legal fees than is typical from New Zealand investors. Transaction fees, I mean, generally I'd say transaction fees are not payable, other than if you are getting investment from angel groups. Angel groups often do seek a transaction fee, and that can be up to 6% of the amount of the investment. That is negotiable, and you should try and negotiate that down if you can. And exclusivity. I mean, from the company's perspective, it's best not to grant exclusivity, but practically, if an investor is going to spend time and money carrying out due diligence on your company, I think it's fair that you do give them exclusivity, but do try and limit it to the shortest period you can, because what you do want to ensure is that your investor is actually engaging in the process in a timely manner, because if they are not going to be able to meet the time commitments that you need, you might need to be able to go out and look for another investor.
So I've just jumped on the submit button, and I'll just show what this sort of operationalizes into by sharing that screen. I was actually going to run through it, but I think we've probably bored people enough. So I'll quickly show. That's it. Quickly show people what this operationalizes into. Is that coming through okay, the term sheet there, Julie?
Yes, we can see that.
Yeah, so this is what the document looks like, and you can see, the business of the company, making free templates and docs, founder Lee Bagshaw, preference shares, investment amount $1 million. And you can download this as a Word document to edit it further, or as a PDF document. And everything that we talked about should be nicely drafted in here. So in relation to liquidation preferences, I was explaining it on liquidation of the company or on sale of the company, the investor will be entitled to receive the greater of 1 times the investment amount. Oh, it's just got a 2 times preference. I must have clicked on the 2 times preference button. Or their pro rata share of the... oh, no, that's okay. There we go. There's an error in there because that's got a 2... It's one for Kenneth to fix. That was embarrassing. Hopefully there aren't any more of those. Drag along. Shareholders selling 75% or more of the shares in the company will have a drag along right in respect of the shares of the non-selling shareholders. And that operationalises probably into about 2 pages of drafting in your constitution. But for anyone that's been involved in these transactions before, that will be obvious what that means. If you haven't been involved, you might not appreciate what it means, and that's why it's good to chat with a lawyer. And we've set out the content of the term sheet in the same way as the document maker, so control terms, other terms, and legally binding terms at the end. In terms of confidentiality is the only one in this case. The term sheet itself is expressed to be not legally binding here until a binding investment agreement is entered into. So if anyone would like me to email them the actual document, I'm happy to do that. Just put your details in this chat box or send us a contact request on our website. Also, if there's any lawyers on the call, let's cancel 1 CPD hour of training. So if you want to, again, just put something in the chat box or shoot us a message on our contact request form or send me an email and we'll send you out a CPD certificate. Were there any other questions accumulating there, Lee, that we should pick up?
I think just one question that we haven't answered and that came earlier on, and that is how long is a piece of string? How long does a typical cap raising transaction take to complete?
What's the starting point?
I guess from let's say, but from signing the term sheet to getting the long form documents done and due diligence.
Yeah. I mean, I would say 2 months, which may seem longer than you might expect, even 2 to 3 months, depending on how quickly your investor moves on due diligence. It can be a lot quicker, but I wouldn't expect it to be. Any thoughts on that, Andrew?
Yeah, I mean, it's so dependent on how sexy your company is in the eyes of potential investors and how good you are at selling that. You know, promoting that sex appeal. It's a marketing exercise, and so the better your company is marketed, more investors you're going to have interested. And frankly, the less questions they're going to ask in terms of their rush to invest in your company. So, you know, creating that FOMO, fear of missing out, be it because, you know, fear of missing out of the next big thing, that's what drives people to move quickly and, you know, and to actually suspend some of the caution in their processes, I suppose. I mean, we've seen some of them drag out for a year, in which time, you know, the company's basically on life support. And when the money comes in, most of the money goes out in paying out all the debts that have been racked up. And, you know, we've seen companies fall over within, you know, literally several months of a capital raise being completed because the founders are exhausted and the money's exhausted and, you know, that just all the impetus goes out of it. I mean, it's probably fair to say that doesn't happen as often now, like investors are more professional now, but the angel groups are quite slow because they're having to wrangle a bunch of people to get on board to look at it. And so high net worth investors, professional investors, informal angels who are used to operating in this space tend to be quicker. They don't have as much process and wrangling to do. I think one of the fastest we've seen recently, Julie, you know, they started talking to investors and about, 6 weeks ago, and they actually have completed the investment, the documentation, and got all the money in. But boy, this woman was an incredible saleswoman, and she was raising capital for a company that already had, 3-4 million revenue and had just signed some big contracts. And she was just an awesome marketer.
Yeah, and so, but that does put it in context in terms of timing. She had a really engaged, interested investor who carried out due diligence really quickly, and yet it still took 3 weeks from signing the term sheet to finishing the deal, and that is as fast as you're ever going to get.
That was all with the questions. So a few people want the questions, so we'll get Finn to send those off to everyone, and there's a few people that wanted the CPD certificates. If anyone wants to, obviously we're doing these webinars for, because we're wanting to build, I guess, our audience. So if you'd like to know more about upcoming webinars, just sign up for our newsletter. We only send it out once a month, occasionally twice a month if we've got big news. So don't expect we're going to spam you with that, but they will have news of further webinars. And, if you enjoyed it and felt like tweeting about how awesome it was, our what is that Twitter handle is TechLawNZ. So thanks everyone, and we will get those docs and certificates out for you, and hope to see some of you in future webinars. And thanks, Julie and Lee.
Thanks, guys.
Thank you.